countdown to 2025 is officially on. And while we may be looking forward to the new year, should you also be bracing for a sizable tax bill? Income taxes are an inevitable part of life, a necessary evil of building and protecting wealth, but they are oftentimes manageable and don't have to derail your financial goals. This time of the year is the best time to make sure that you have everything in order so that come tax season next spring, you're both prepared and informed. Hi, I'm Steve Pitchford, Director of Tax and Financial Planning at Towerpoint Wealth. Towerpoint Wealth is a leading wealth management firm in Sacramento, California, and we work closely with our clients to evaluate and execute on a comprehensive investment, retirement, tax, and financial planning strategy that's tailored to your unique financial goals, needs, and aspirations. In this video, I'm going to walk you through 6 key tax considerations that you as an investor should be aware of as we head into 2025 to ensure you can confidently navigate this dynamic tax climate and start your year on the right path. Let's dive in. First, let's start with a big one: capital gains distributions. Capital gains distributions occur when mutual funds or exchange traded funds sell investments within the fund throughout the year at a profit and then legally are required to pass these profits on to you as an investor in the fund, unfortunately as a fully taxable distribution. The tricky part is, even if you haven't sold your shares during the year, you may still owe taxes on these distributions as they're automatically passed through to you even if you reinvest them. This means you could face an unwanted tax bill simply for holding the fund and doing nothing. So how do you avoid this trap? Focus on holding tax-efficient investments in taxable accounts, such as non-retirement brokerage accounts or trust accounts. And whenever possible, hold investments that generate these capital gains distributions in tax-advantaged accounts like IRAs or 401ks, as this is income that is deferred if held in a pre-tax retirement account or tax-free if held in a Roth IRA retirement account. Next up, let's talk about one of the biggest changes looming on the horizon: the scheduled expiration of the Tax Cuts and Jobs Act at the end of 2025. The Tax Cuts and Jobs Act, passed in 2017 under President Donald Trump, was one of the most significant overhauls in the U.S. tax code in decades. It was designed to 1. Simplify the tax system, 2. Reduce tax rates, and 3. Stimulate economic growth. While many of its changes benefit both individuals and businesses, some of the provisions are temporary and set to expire at the end of 2025. With the sunset of these provisions, we could see higher tax brackets, a lower standard deduction, and a reduced child tax credit. Well, at Towerpoint Wealth, we believe that there is a reasonable probability that the Tax Cuts and Jobs Act will be extended. If it is not, it is important to prepare for a potential increase in tax liability. Consider working with your advisor to decide on strategies like accelerating income into next year, increasing charitable contributions into 2026 and future years, and reviewing your available deductions. Now let's talk about Roth IRA conversions, which can be a smart move when you're in tax rates that are relatively low. When you convert traditional IRA assets to a Roth IRA, you pay taxes now on the amount that you convert, but your future investment growth and withdrawals are then tax-free. This can be especially advantageous if tax rates rise after 2025. Consider partial Roth conversions over several years to amortize or spread out the tax impact over a number of years. This can also provide more flexibility in managing your retirement income. But remember, the right strategy for you is going to come down to your unique financial situation, so be sure to consult with your tax advisor before making any drastic changes to your plan.
Are you a busy investor always on the go? Take the powerful knowledge of Towerpoint Wealth with you wherever you are with our original podcast, A Wealth of Knowledge. Now available on all major streaming platforms, and best of all, it's completely free to download and listen. Now that's an investment worth making. Click the link above and start listening today.
Next up is estate planning. The Tax Cuts and Jobs Act significantly increased the federal estate exemption, making it easier for families to pass on wealth without triggering estate taxes. But if the Tax Cuts and Jobs Act sunsets, that exemption could be cut in half, potentially exposing more estates to taxes. To mitigate this, consider gifting assets to heirs while the exemption is higher, or work with your estate planning attorney and financial advisors to strategically use certain types of trusts to protect and transfer wealth in a tax-efficient manner. Another powerful tax minimization strategy is what is known as tax loss harvesting. Tax loss harvesting allows you to sell investments in a taxable account at a loss, allowing you to offset taxable gains, ultimately reducing your overall tax liability. Say you have $8,000 of capital gains distributions in a taxable account and also an $8,000 loss in a taxable account. By realizing this loss, you can offset the capital gain, therefore reducing your overall tax liability. But here's the trap. Many investors wait until December to harvest losses, potentially missing out on opportunities to do so throughout the year. This creates complications if assets grow and perform well at the end of the year, as we have seen throughout recent years. Instead, take a year-round approach to loss harvesting. Monitor your portfolio regularly for opportunities, and don't forget about the wash sale rule, which requires you to wait 30 days before repurchasing the exact same investment. Last up, let's dive into tax-efficient asset location, a strategy that can help you reduce your overall tax burden by locating and placing your investments in the right type of accounts. Here's how it works. Different investments are taxed in different ways. For example, interest from bonds or dividends from real estate investment trusts, also known as REITs, are taxed as ordinary income, which is taxed at a higher tax rate. On the other hand, long-term capital gains and qualified dividends are taxed at favorable rates, oftentimes at 15%. The key is to match these type of investments to the type of account where they'll be the most tax efficient. For instance, you might want to hold tax inefficient investments like REITs, taxable bonds, or high turnover mutual funds in tax advantaged retirement accounts like IRAs or 401ks. These accounts allow you to defer or even eliminate taxes on investment income. Investments that are more tax efficient, like index funds or municipal bonds, which generate less taxable income, may be better suited for regular taxable accounts. Why does this matter? Optimizing where you hold your investments can significantly reduce the tax drag on your portfolio, helping your wealth grow and compound faster over time. If you're unsure whether your portfolio is tax efficient, this is a great time to review with your financial advisor. They can help you structure investments to maximize returns while minimizing taxes. As you can see, the best way to navigate the tax landscape heading into 2025 is through thoughtful planning and a proactive approach. This may seem like a daunting and complex task for you as an investor, but the good news is you don't have to do it alone. At Towerpoint Wealth, we specialize in helping individuals and families like yours make informed financial decisions to minimize taxes and maximize and protect your wealth. Please click the thumbs up button if you've enjoyed this video, and if you'd like to discuss strategies tailored to your unique situation, please reach out to us here at Towerpoint Wealth today. And don't forget to hit that subscribe button to subscribe to our YouTube channel to be alerted to new educational content we produce and for additional insights to help you stay ahead in your financial journey. Thanks for watching, and we'll see you in the next video.